show. But let's talk about alternative assets appear to be a house of cards. I remember I used the same terminology back before the tech boom and bust about 20, not the tech boom, but the bust about 25 years ago. And at the time, I got to say, it was a little bit early, probably like a year or so. But eventually, that house of cards collapsed, as we all know. The more I read about alternative assets, the more I scratch my head like, how is Wall Street getting away with this? And I've always said Wall Street is not on your side. Wall Street is there. There's a lot of greed on Wall Street, and it's there. And these alternative assets are something that I don't know how people can sell them. And they are sold. They're not invested in.
I mean, you talk about this all the time. I mean, it's interesting you talk about like the tech boom and bust, and it's not necessarily the same as that, because at least those were public. People were just losing money publicly. But, you know, you used to call them the tenants in common. There's other deals that continued to arise, and it just kind of changes the private REITs. It changes the name, but the underlying concern of tying your money up and not really knowing the true value of it, that's the big concern that you have with these alternative investments. There's no secondary market, so it's very challenging. And I just think in the end, I mean, it's the small investor that I think will end up paying dearly for investing in these alternative assets. And it's funny, Harrison and I had this conversation, I think, while you were gone, but we said the problem is we talked about an accredited investor. And it's not that hard now to be an accredited investor, but people hear, oh, the rich people, they're the ones doing these alternative investments, so I should be doing the alternative investments. And I don't think it's going to be your super rich people that get hurt by these. I think it's going to be the small person aspiring to be like a rich person doing these alternative investments, and I think they'll be the ones, unfortunately, that get burned.
And you said there's no secondary market. There kind of is, but I mean, we've had clients come over. It's terrible. It's like a 50% haircut, I think, some of these.
Sometimes it's pennies on the dollar. I mean, it's like some, actually. We have one. This guy has a $25 alternative investment, we'll call it, because it's basically depreciated so much, and he has to pay a fee to Schwab every year to hold it, and he can't get rid of it because nobody wants it. It's worth $25. I mean, these illiquid investments, and I'm not going to use a blanket statement, some of them will be okay. Some of them will probably have great returns. I'm not going to say
some of them,
but that's the key word.
Right.
Some of them. Many of them, I think, are going to be a huge challenge for the everyday investor, because you get locked into them. All of a sudden, let's say, hey, I invested in it. I want to buy a house. Sorry, you can't get out of it. You know, I mean, it gives you no flexibility.
And as an example, a company called Hamilton Lane Private Assets can buy, and this is how, again, we're going to dig in deep to this, on how they can buy private stakes from other holders at a discounted price. So again, if it's like a dollar because they're buying it, they got it on sale, they're paying maybe 85 cents on the dollar. Okay, so they got a deal. But they can somehow magically, when they buy it, now they can mark it back up to the value. So somehow that 15 cent or 15% that they discount is gone. So automatically now it's worth more. I don't know how. I don't think they're being looked at very closely yet. I think it's going to take some major losses from the small investor before the SEC gets involved.
Yeah, and I mean, it's just kind of surprising because, I mean, you talked about the fact that they mark it up, but I mean, it doesn't even matter how they paid for it. I mean, even if it was a competitive auction, why can you all of a sudden create this value essentially out of thin air? Or again, I'm going to come back to how the small guy gets hurt. Mm-hmm. These big companies where they're like, they can buy it from the small guy that wants to get, or maybe needs to get out of it, and then they get a great deal on it. And they're essentially able to capitalize on the fact that it's illiquid, needing to, I almost said steal, but capitalize off the little guy that needs liquidity.
Capitalize is a good word. Yeah. And I almost will kind of say, it's kind of steal. Yeah. So, and this also reminds me, go back to 2008, the mortgage crisis. They had collateralized mortgage obligations. They were known as CMOs. And I never understood, because what they do, they had these troughs. And they could take like different ratings of different troughs and say, well, these are AAA, these are AA, these are like C. But if we combine them all together, we can say the CMO is a AAA. Well, that made no sense to me. And again, we saw what happened with that. And I don't know how, and I think Wall Street gets away with it because the regulars don't look at it until somebody gets burned on it. Something major happens like 2008. They do that. And I'm just trying to warn clients, if you have, not clients, but listeners, everybody, if you have alternative assets, Well, you may be stuck in them, but if you don't have them, don't get them.
Yeah, I mean, there's why would you lock your money away? I mean, honestly, the fact that it's illiquid, I think I need at least a 10% annualized premium over what I would get, because it's like, why would I need to lock my money away for, frankly, many times an undefined period? Maybe it's 5 years. Maybe I've seen some for clients 15, 20 years ago, and they're still not out of them. So it's like, I would need a huge jump up in the rate of return that I would receive, and nobody can guarantee that.
Do you think by chance, when these are being sold, they're forgetting that little detail and saying, oh, this is great, you'll have no market fluctuation, don't worry about it. But the salesperson, I will call them salespeople, not advisors, because that's what they're doing. They're selling these products. They're not telling the whole story. That's what I think is happening.
Yeah, I mean, I definitely think that's the case. We've had people ask us about these before, and they're like, no, they said I can get out. And I'm like, good luck with that. I mean, I don't think that's going to be the case. And as you said, it's that secondary market is there, and maybe you can get out, but at what cost?
Yeah.
Is the question. And kind of coming back to the accounting piece that you brought up, and this kind of blew me away, but in 2024, there were $162 billion worth of secondary deals with an average discount of 11%. So again, the question is, how can they magically create essentially $18 billion worth of value on those secondary deals instantaneously? I mean, it's kind of like people when they say, my house is worth $1.5 million. But somebody buys it from you, and only somebody will pay $1.2 million. Your house is not worth $1.5 million. It's worth $1.2 million. If the market will only pay an 11% discount, that is what it's worth, not what the essential value is that you can mark it up to in the net asset value. To me, that is just crazy that you can all of a sudden now mark it up to the net asset value, even though nobody else is willing to pay that.
Well, let's talk about the fees, because the incentive fees that private equity firms have, like a Hamilton Lane, they earn from 10 to 12.5%. I mean, just think about that. So for you to break even, they've got to make at least 10% for you to break even. Now, if you want a 5 to 10% return, they now got to do 15 to 20%. I also went to AI and I looked at what do brokers get paid on these? Because we're not a broker, we're an advisor, so we don't sell these. What do brokers get paid? Well, the upfront fee can be as high as 5.5%. That's the high. And then on top of that, there can be an ongoing service fee of 4%, then a redemption fee. I mean, these alternative investments, some of them will have to make 20% before you break even after paying the private equity firm and paying the broker. It's just ludicrous. Do not go into these.
And I'm guessing when they mark it up to net asset value, that's where they're charging their fee. It's not based off the market price. It's just, honestly, I want to be very careful in saying they're all bad, because I'm sure there's going to be some where people have done very well. I mean, I've seen private REITs sometimes work out for people. Yeah. Actually did pretty well. Good. I'm happy. But I've seen way more horror stories. And I think fast forward 5 years from now, it's going to be very similar, where you're going to be like, oh, I should have listened to the Smart Investing Show and not done that alternative investment.
And again, doing this for over 40 years, I have a lot of experience. Going back to the 1980s, they had a thing called limited partnerships, and only a third or 30% of people made money on those. I don't like those odds. I mean, I want to have at least, an 80% chance of making money, not 30%. That's terrible. Yeah. So I think the broker in Wall Street makes the most off these alternative investments.
Yeah. So I guess just be careful. I mean, it's just something that you're tying your money away. Know the downsides. It's, to me, not worth the risk.
No, definitely not.